Welcome to the Federal Retirement Podcast. My name is David Rates from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you may register by joining our email list at bfgkc.com. We also provide in-person retirement planning and benefit education to federal employees. To learn more about these seminars or to schedule a seminar at your federal agency, go to our website at bfgkc.com. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website at bfgkc.com or email me at david.rates@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoy this topic and hope to connect with you soon.
Well, thanks for tuning in to this month's call, everyone. Thought for the day today would be the difference between when can I retire versus when should you retire. When can you retire? That one hinges on your first eligibility to retire versus when should you retire? When does it make the most economic sense to retire? And oftentimes the answer to this one hinges on usually one of the big variables is how burned out people are. It's one thing if you work for the federal government and then you retire and ride off into the sunset, and that's that. Other times people are pretty burned out and they're trying to get out of the federal government like ASAP, but they know they might be looking at an income gap. If that's the case, that's not necessarily the end of the world, because depending on what that income gap is, if you can go work 2 or 3 days a week doing something to generate that income, sometimes that's a better option than the day-to-day grind working for the federal government, because you can pick and choose your hours and you got more flexibility there. So, and then oftentimes just the difference in timing of like a few months or a year can have a noticeable impact on the long-term benefits that are payable after the point that you retire from the federal government. So the decision is an important one that oftentimes impacts decades. So moving on, just a refresher about some bullet points on the three key retirement ages. MRA, which would be 56 or 57, age 60 and age 62 are the three big ones. So some caveats about minimum retirement age. Like I said a second ago, for most people it's 56 or 57, but this one is pretty rare. With the clients that we work with, most of the time when people are retiring around 56 or 57, they're folks in that special category of like law enforcement officers or air traffic controllers that have a mandatory retirement date. Usually the sweet spot of where we see like normal FERS retirees is right into that age 60 zone. But it's also important to know that you max out your pension calculation at age 62, assuming that you have 20 or more years of service. So the trade-off, if you're retired MRA, you get to retire earlier, but your pension payment is going to be noticeably lower. Age 60, as long as you hit that retiring at age 60 with at least 20 years of service, you don't need to worry about a reduction in your pension, and then you're eligible for that first supplement as well. And then at 62, you have the highest pension calculation, but there's no first supplement that's payable because now you're eligible to turn on Social Security. And again, everyone's benefits are the same, but their life plans are all different. So sometimes it's different for everybody's individual scenario. But in a general sense, usually right around 60 is kind of like the sweet spot for the time frame of most FERS employees. Just a refresher on the pension calculation formula: MRA with 30 years, age 60 with 20 or more years, or age 62 with at least 5 years. If you hit one of those three, that pension calculation is 1% times high 3 times years of service. And it has a noticeable bump, assuming that you hold on for 2 more years and work to age 60 with 20 or more. That pension calc goes up to 1.1 times high 3 times years of service, which doesn't seem like a lot, but in dollars and cents, it's using a high 3 of $100,000. It's the difference between $2,000 of annual income at the start of retirement, and then that goes up with cost of living increases as well. So it's an important piece of the pie, but oftentimes whether or not you want to go out at 62 or 60 depends on the level of burnout that you're currently dealing with. And even if 60 is the time frame that makes the most sense, that's not the end of the world. It's just no making sure that you don't have any unpleasant surprises and you have a plan that's mapped out the way that it makes the most sense for you. So moving on to the first supplemental piece. So when you check that box of minimum retirement age with 30 years of service or 60 with 20 years of service, you're eligible for the first supplement. Remember, the first supplement, it's technically not a Social Security payment, but it kind of mirrors Social Security. It's designed to bridge the gap between your FERS retirement and Social Security eligibility, which is age 62. MRA with 30, 60 with 20 would be those timeframes where you'd be eligible for the supplement. And in a nutshell, the more years of FERS service you have under your belt at the point of retirement, the closer your first supplemental payment is going to be to your age 62 Social Security payment. So the first supplement is just based on your FERS service with the federal government, and then your Social Security payment takes into account all the years that you contributed to Social Security. So like jobs that you had as a teenager, those are indexed for inflation. So it's not uncommon for the Social Security payment to be a couple $100 a month higher than your first supplement. Some important bullet points on that first supplement. Early temporary bridge payment for certain FERS retirees who retired before age 62. This one it's not paid by Social, it's paid by the Office of Personnel Management. So OPM pays the first supplement. And it's designed to approximate the Social Security benefit that you would have earned during your federal FERS service. It automatically ends at 62, whether or not you turn on Social Security. But most of the time, when people are used to getting that monthly income coming in from the supplement, they're looking at turning Social Security on at 62. The difference would be whether or not you didn't want to worry about the earnings test, but oftentimes you would have had to have thought about that in the days, months, and years leading up to 62. So, but the caveat about the first supplement and the earnings test is that they don't let you go make an unlimited amount of money while you're on that first supplement. But oftentimes people are particular about what counts as earned income and what doesn't. So non-work income or passive income doesn't count against the earnings test. So passive income would be like government benefits, government pensions, investment earnings, capital gains, payments from annuities. Or if you're a 1099 employee, for instance, or self-employed, the income counts when you receive it, not necessarily when you've earned it. So over the years, depending on what people's post-retirement plans are, if they have businesses outside. So we've seen clients that will take their outside business and wrap it up into a limited liability corporation that their spouse is the beneficial owner of, which gives them a way to circumvent that earnings test. But that one just kind of depends on how creative you want to get with your tax planning. So there are ways around it, but again, it depends on what your plans are post-retirement from the federal government. Switching a few more bullet points about the supplement. Oftentimes moving from the first supplement to Social Security is an increase in monthly income. Because going back to that idea, the first supplement is just based off of your years of time working for the federal government. Social Security indexes any time frame that you're contributing for inflation. So it's not uncommon for people to see an automatic pay increase at 62 of somewhere between $500 and $1,000 a month, just automatically between the supplement stopping and then them being eligible for that higher Social Security payment at 62. The Social Security earnings test for 2026 is $24,480 annually, or $2,040 monthly. So like last year was interesting because a lot of people were getting buyout offers. Sometimes that speeds up people's time. We had some clients that were planning to retire anyways, and it was a nice extra piece of the pie, a nice cherry on top. And we had other folks that maybe weren't planning to retire for like 3 or 4 years, but had this buyout offer on the table. And even if they're looking at an income gap, if they could go, let's say it's 2,000 a month, if you can go make 2,000 a month, stay under the earnings test amount, and that fills your income gap, but you don't have to do the day-to-day grind working for the federal government, and you can work 2 or 3 days a week and have the option to pick and choose how you want to structure that. That sometimes is an enticing thought for people, or a motivating factor for retirement. And then the last bullet point here, no cost of living adjustments on that first supplement. So that one's static from the point that you retire until you get to 62. There are cost of living increases on Social Security. So moving on to Social Security. So usually this one is a question of when does it make the most sense for me to turn on Social Security? Oftentimes, we tend to gravitate towards turning it on sooner as opposed to later because we try to remind folks that you got to be alive to win with Social Security. And God forbid you defer taking that benefit, pay in all those years, turn it on at 70 to get the maximum payment, and then pass away at 71. That would be the worst case scenario. So just a few caveats about Social Security, especially the statement. When you're looking at the state, like the old statements, the big bold number on the front of the page is your benefit is payable at full retirement age. So full retirement age hinges on your birthday, which depending on the year that you're born, if you were born 1960 or later, your full retirement age is 67. So from 62 to 67, for instance, if you turn that benefit on any time between there, you have you have to worry about the earnings test amount. But once you get past your full retirement age, there's no earnings test anymore. You can make an unlimited amount of money and they don't care at that point in time. So knowing the amount that you can make relative to when you want to turn that benefit on is an important piece of the pie. Moving on to FEHB, the Federal Employee Health Benefits. FEHB is a major benefit for federal employees. Oftentimes in the private sector, people gravitate towards 65 because that's when they're first eligible to turn on Medicare. And if you're retired before that, you're most oftentimes in a boat where the health insurance that you had with XYZ Corporation, what might have been competitively priced while you're working there, but the second you separate service, the price goes through the roof. So that puts people in a spot where they're looking for like an individual policy from retirement to age 65. The federal government treats retirees like active employees and continues to subsidize about 70% of that total premium. So that really is one of the things that allows federal employees to retire earlier than 65 and have it really make sense in terms of dollars and cents and not have any gaps in health coverage. Same subsidy continues that you'd be used to getting while you're actively employed, and the coverage follows you. Even if you retire and move someplace else, usually that one is a variable of checking the most competitive plans based off of your zip code. So few important bullet points about FEHB in retirement. You must have been insured at the point of retirement. The retiring employee must retire on a first pension annuity. The employee must have been enrolled or covered as a family member for 5 years preceding your retirement or since the first opportunity to enroll. And the big one at the bottom is the government treats your surviving spouse as an active employee and continues to subsidize that FEHB premium for the remainder of that surviving spouse's lifetime, which is a big deal in terms of maximizing the money that you're spending on health coverage. So circling back to that 5-year requirement, we had a client that was looking at a mandatory retirement date in 4 years, and he had to scramble to get a waiver to stay on past age 56 because he was trying to get that 5 years in for health insurance before he was forced to retire. So knowing caveats like that can be an important piece of the pie, because in that example, the FERS employee was on his wife's health care, thinking that it would be a better option, not thinking about the portability of that health insurance after the point of retirement. A few more caveats about, or I guess this one's just a refresher on the amount that the federal government pays for that health coverage. So even as a retiree, Uncle Sam continues to pay the lesser of 72% of the FEHB program-wide weighted average premium, or 75% of the total premium for that specific plan. So in a nutshell, that subsidized health insurance is going to carry with you in retirement. And assuming you leave either the partial or the maximum surviving spouse benefit, that coverage is going to follow your surviving spouse through their lifetime as well. So going back to that thought about how do you shop the different plans, because they're different based off of your geographic location and they're constantly changing and evolving from one year to the next. But one of the easy tools is you go into OPM's website, and if you go to opm.gov, click on insurance, healthcare, plan information, and compare plans. This one's just a snapshot of the page that you can use to shop them by zip code. And then breaks down 6 different plans based off of your geographic area because the plan that's the most competitive in Kansas City might not necessarily be the most competitive plan in Florida, for instance. Going into open season too, sometimes it's nice to shop the different plans and see what the differences in one year to the next between one or the other. Moving on to Medicare costs for 2026. So Part A would be your hospital insurance, 1736 per benefit period, zero co-insurance for days 1 through 60, 434 a day for days 61 through 90. And it's pretty rare to be in the hospital for 91 days plus, but Part B would be all the tests that you would have done while you're there. So Part B deductible 283, and then the standard monthly premium for most people is about 200 a month, depending on your income. And then you don't need to worry about outside FEHB. You continue forward with FEHB, and it covers the gaps that people in the outside world go to buy Part C and D plans for. So you got all the bases covered with health insurance, assuming you check all those boxes, which is a big concern for a lot of people going into retirement. So moving on to, thought it'd be worthwhile to just throw an illustrative example in. Somebody we were talking to last year who was planning to retire at 65. And then we crunched the numbers and realized that based off of pension, money spending off of TFP, the first supplemental payment relative to the deductions that were going away at the point of retirement, this person was in a spot where they could retire at 61 and not take a dip in income, which sped up her retirement time frame by a few years. So, like I said a second ago, the person was planning to retire at 65. After we crunched the numbers, realized that maybe 61 would be a better time frame. So in this scenario, gross income was 8,800 a month while they're currently actively employed. Current deductions while actively employed were about 6,400 a month. So net monthly income currently was right around 2,400 a month and change. So it's important to know that you have a lot of stuff that you pay for while you're working full time that goes away at the point of retirement. So in this scenario, it's about 6,400 of total deductions, but at the point of retirement, federal taxes, state taxes are a piece of the pie. Federal employee health benefit, that one's always going to be a deduction. FEGLI, that one could stay on the books or not, depending on whether or not you want to hang on to some FEGLI insurance. And then dental and vision. But FERS retirement contributions, TSP contributions, no more Social Security tax, no more Medicare tax. Usually people are paying a lower FEGLI premium, no more local tax. You do have dental and vision. And then the savings allotment often depends on whether or not you're just like sending that money to a savings account or sending it to an account that you pay for like your mortgage with, for instance. So a lot of times we'll start by keeping those savings allotments in. So even in that scenario, deductions went from 6,400 down to 3,800 on a monthly basis. With that being said, the net in this scenario for the retiring employee going out at age 61 put them at 2,400 and change on a net monthly basis, which was essentially the same amount of money that she was bringing in while she was actively employed. It's just having 3,800 of deductions versus 6,400 put her net in a lot closer zone that she was thinking. So it allowed her to retire at 61 versus 65. So that would be the idea that you want to marinate on or think about when going into retirement planning. So what are you really optimizing? Your flexibility, income, lifestyle, and longevity are a big one too, because sometimes the best retirement plan isn't necessarily the best life plan. But if you take a look at things and all the certain check boxes hitting the right spot, sometimes people can speed up that time frame for retirement a couple of years faster than they were otherwise planning. And then just a few high-level comparisons about MRA versus 60 and 62. Obviously, MRA is an early retirement, but the pension payment is going to be lower. You are eligible for the first supplement. The first supplement ends at 62. At age 60, you get a higher pension calculation. You still have that supplemental payment. You're not getting the maximum calculation factor, but you still have unreduced first pension and the supplemental payment rolling in until 62. And then at 62, Social Security eligibility, so no supplement is payable, and you have the 1.1 times high 3 times years of service. But you worked a few more years, so there's trade-offs there. And bringing it all together. Retirement, it's less about zeroing in on the specific date and more about building the strategy and making sure that your gross income is where it needs to be and there's no surprises with your deductions on a monthly basis as a retiree. And the overall goal is to retire with a plan to support your income and lifestyle, or put yourself in a spot where you're not taking a major hit in terms of your net monthly income. And even if it is a small hit, if you can replace that with outside income from employment 2 or 3 days a week, sometimes that's not a bad option for folks. Take a look at things with all the pieces of the pie added together. Don't just zero in on the pension piece, or don't just zero in on the TSP piece. You want to look at what's the income or total income coming in from pension, TSP, supplement, or Social Security relative to all the deductions that I'm paying for today and all the deductions that I'll be paying for as a retiree. All right. So, how do you start a strategy? At least with us, it's usually about 2 or 3 meetings. So the first meeting is what we call a fact-finding meeting, where we send you a list of identifying information to gather and bring with you or send our way. Having it, fact-finding is kind of like information gathering and sharing. So the more accurate that identifying information is, the more accurate we can be. In the second meeting is where we put together a written version of your plan, which just breaks down choices that you have for each different piece of the pie. For instance, the FEGLI insurance that you have, what are your options at the point of retirement? Which survivor benefit does it make sense for you to go with on your first pension? Usually people, they've been in accumulation mode with TSP and they're looking for an income strategy or an effective way to take money out of the TSP savings. It's going to put them in a spot where they have enough money rolling in on a monthly basis, but also have enough money that's liquid and growing and set aside for usually the big four there: house, car, medical, vacation type of withdrawals. So pinpointing an income amount and then an amount that you have for withdrawals, emergency opportunity withdrawals is an important piece of that pie too. And then in subsequent meetings, it's a matter of tweaking, refining, and finalizing the overall plan to the point where it makes the most sense for you, and then implementing it and then reviewing it on an ongoing basis. So the relationship doesn't end after the point of retirement for the folks that we're working with. So what do you need to start a meeting? Right up at the top of the list is just a copy of a recent leave and earnings statement or a recent pay stub, because that's where we get those deduction amounts, so we can run the net monthly income comparison. Copy of any retirement estimate that you can get, whether or not it's GRB, an estimate from HR. Those are always helpful. A recent TSP statement, so we get an idea of balance, how the money's invested, the amount that you're contributing into TSP, which portion is traditional, which portion is Roth. So those are all important pieces of information to have. And any other investment state or any other accounts that you had earmarked for retirement income, so like old 401ks, IRAs, traditional outside IRAs that are traditional or Roth, and then detail any outside life insurance policies, whether or not it's term, like an older life policy, or whether or not you have outside long-term care insurance. Those are all important pieces now. Just a recent Social Security statement is important too, because every year you're paying in, the benefits constantly changing and evolving a little bit. Divorce decree, if that's applicable, is an important one to just reread if you haven't taken a look at it in a while, and make sure there aren't any unpleasant surprises coming down the pipeline. And then oftentimes people want to incorporate spouses benefits into the mix too. So if that's the piece of the pie for your scenario, feel free to bring that info as well. And if you think of any questions come to mind that you want to run by me, feel free to give me a call, or you can send me an email directly, or you can always submit those questions via the website. So thanks for tuning in, and hope to talk to you guys in the near future.